Okay, hello and welcome. So we're picking up on the second lecture video for chapter 3 where we left off. I ended the last lecture video by talking about this framework for adjustments. And so remember, we have adjustments at at high level. We can have the situation where we paid cash before the expense or the revenue is recognized, or we paid cash after the expense or revenue is recognized. So in the situation of paying cash before the expense is recognized, that'd be the situation of prepaid expenses. So for example, the insurance policy that we bought in the prior lecture video for 2 years, that's an example of a prepaid or deferred expense. We also have the situation is where we get paid up front and then we have to provide the service in the future. That is a liability. But what we have to recognize is maybe that during the accounting period, we have performed some of the services, so we can reduce that liability. So we'll be looking at journal entries for prepaid expenses, unearned revenues. We'll also be looking at adjusting journal entries for accrued expenses and accrued revenues. So accrued expenses would be a situation where we have to recognize rent expense because it's been incurred, but we don't pay it until the next accounting period. Accrued revenues would be a situation is where we've performed the service during this accounting period, but we don't get paid until the next accounting period. So we have to recognize the revenue in this accounting period because of the revenue recognition principle that says we recognize revenue when it's earned. Okay, so we're going to be doing adjusting journal entries for each of these 4 scenarios. These are made at the end of the accounting period. Okay, we're going to do these at the end of the accounting period, and we're assuming that the end of the accounting period is on December 31st, and so that our accounting period coincides with the calendar year. Okay. So let's look at the first one, our prepaid or deferred expenses. So as I say on the next page, prepaid expenses refer to those items paid for in advance. Those are assets. That's an asset. When they are used, they become an expense. So when we think back to that insurance policy, fast forward, pay $2,400 for the 2-year insurance policy. We're going to do 2 journal entries because on December 1st, we have to recognize that we've bought this insurance policy. That's what we're recognizing on December 1st, is we bought this insurance policy. So look at this in terms of our accounting equation. Assets equals liabilities plus equity. What's going on? Liabilities and equity are not being affected at all. One asset, insurance policy, which is a prepaid expense, is going up. Prepaid is going up. One asset, and what do I pay for that with? Cash. Another asset, cash, is going down. So in terms of how this affects the accounting equation, total assets, liabilities, and equity are unchanged. It's just that one asset, prepaid expenses, goes up by $2,400. Prepaid insurance, to be more specific, goes up by $2,400. Another asset, cash, goes down by $2,400. So if you recall, in terms of our debits, credits, I've got my assets equals my liabilities plus my owner's equity. I've got debits to increase assets, credits to decrease assets, credits to increase liabilities and equity, and debits to decrease liabilities and equity. Okay? So if we apply our debits and credits with our accounting equation to this situation to help us do the journal entry, we know that our prepaid insurance is going up. Prepaid insurance is an asset. How do we increase an asset? With the debit. Cash, which is another asset, is going down. How to recognize that an asset is going down? With a credit. So I will debit prepaid insurance, $2,400. I write my debits first, and then I indent, and I write my credit to cash, $2,400. Okay? Debit prepaid insurance, credit to cash. That is on December 1st. What about on December 31st. Well, on December 31st, what we have to recognize is, returning to this bullet, when those assets are used, they become expenses. So we have to recognize that from the 1st to the 31st, that 1 month of our prepaid insurance policy has expired. We have to recognize that 1 month has expired, and that we have to recognize that as an expense. So what we're going to do, we look at our accounting equation, and we think about what's happening. Our prepaid insurance is going down. Why is our prepaid insurance going down? Because 1 month has expired. And how much is it per month? Well, I could take my $2,400 divided by my 24, it gives me $100 a month, right? $100 a month. So I have $100 less of my prepaid insurance policy. Where do I put prepaid insurance? That's an asset, so my assets are going down by $100. If we look up here, it says they become, when those assets are used, they become expenses. So I'm going to recognize that as insurance expense. As expenses go up, what happens to equity? Equity goes down. That's how this keeps the accounting equation in balance. So remember, we have our debits, we have our credits, we have our debits there. Okay. How do I recognize an expense though? How do I recognize that an expense is going up with the debit? Why? Because as expenses go up, equity goes down. Okay. So to do my journal entry here on 12/31, and it says right over here, adjusting journal entry. So this is one of the adjusting journal entries that we'll be talking about. These are done, as I said earlier, at the end of the accounting period. So on 12/31, I will debit insurance expense for $100, and then I will credit prepaid insurance for $100. Debit insurance expense and credit prepaid insurance. And that's how this keeps the accounting equation in balance. By crediting prepaid insurance, I'm recognizing that 1 month of my prepaid insurance policy has expired, and that when that asset is used, it becomes an expense. And so I'm recognizing that my expenses go up. I recognize an expense going up with the debit. Why? Because debits decrease as expenses go up, equity goes down, and so the way I decrease equity is with the debit. So debit insurance expense, credit prepaid insurance. Another example of prepaid expenses is supplies. Okay, so let's look at this example. It says during the year, Fast Forward purchased $9,720 of supplies. Fast Forward recorded the expenditures in the asset account supplies. So that means, let's just say they did this all on, I'm just going to make up a date, on June 1st. So on June 1st, they purchased $9,720 of supplies. Let's get the journal entry on June 1st. Okay, I'm just adding that to the problem. So what they did, they purchased $9,720 of supplies. So they debited supplies, the asset, for $9,720, and then they credited cash for $9,720. That's what they did on June 1st. Now on 12/31, they have to recognize that some of the supplies have been used. So what they purchased $9,720, so they had $9,720 worth of supplies that they could use. And then they did a count at the end of the year on December 31st, and they said, we have only $8,670 worth of supplies on hand. Well, what happened to them? We used them. How do we get to 1,050 of used supplies? We took 9,720 minus 8,670, 1,050 of supplies were used. If we look back up here at this bullet, when those assets are used, those supplies are used, they become expenses. That is a cost of doing business. So on 12/31, we have to recognize that we used 1,050 worth of supplies. Well, how can we do this journal entry? We can look to see what we did up here. Very similar. We would debit supplies expense for 1,050, and then we would credit supplies, the asset, for 1,050. Crediting the supplies, the asset, then recognizes that we have used 1,050 because crediting an asset means it's going down. It's pushing it down. So then after crediting supplies for 1,050, I could take my 9720 minus my 1,050, and then it reflects the 8670, which is how much supplies I actually have on hand. And as we say up here, when those assets are used, they become expenses. So this is the supplies expense 1,050. This shows up on the income statement. This is a balance sheet account. So it's moving from when those assets are used, they're moving from the balance sheet to the income statement. Okay? Let's look at one more example, which is depreciation. The idea of depreciation. That's another concept related to prepaid expenses. Although it doesn't fall under prepaid expenses, the current asset, it just falls under plant, property, and equipment. But you can think of it conceptually as a very similar idea. Okay? Depreciation, though, relates to long-term tangible assets that are used to sell our products and services. So examples would be buildings, machines, and vehicles. These help us to generate revenue, and they're used over, it says here, long-term. They're used over multiple accounting periods. Tangible. Can you touch a building, machine, vehicle? Yes, you can. Okay, and those are used to help us generate revenue. So think about maybe this building that I'm in, Woodard classroom building. This helps us to generate tuition revenue. So it is a tangible asset because I can touch it, and it's long-term because it's going to be used over multiple years to teach students to generate tuition revenue. The idea of depreciation is a little bit different than what you've learned about before. You may have bought or been given counsel about buying a car. People say don't buy a new car, because as soon as you buy a new car, it's depreciated 20% right off the lot. Well, what are they talking about there? They're talking about loss of market value. That's not what I'm talking about in terms of depreciation as an accountant. What I'm talking about depreciation is taking the cost of this building that I purchased this building for and allocating it over the number of years that I will use that building to generate revenue because of the matching principle. Okay? So what I'm going to be doing, let's say we buy a new building, a new classroom hall for Mary Washington. We buy that building. That building is going to be used over multiple years, multiple accounting periods to generate tuition revenue, to teach students. Therefore, what I have to do per the matching principle is I have to spread the cost of purchasing that building over the years that I use it to teach students to generate revenue. Why do I have to do that? Because of the matching principle. And that process is called depreciation. Okay? If we look at our formula for calculating depreciation, and this is just called our straight line method, we take our asset cost minus our salvage value divided by our useful life. The useful life is our estimate of how long we think the asset will be used. 30 years, 20 years, 5 years. Okay? When I used to work in industry, we had some standards. For example, we would say a laptop. If we used a laptop, it would be depreciated over 5 years. So obviously certain assets will be depreciated faster than other assets. And one determination of the useful life, or one criterion that helps determine the useful life, is obsolescence. You would think an iPhone would probably have a pretty short useful life, especially compared to a building. Salvage value is the dollar amount that we think the organization thinks we can sell it for at the end of its useful life. So at the end of the useful life, we have a computer, and at the end of the useful life, we think that we can sell it for $1,000. The salvage value is $1,000. Again, we take the asset costs minus the salvage value divided by the useful life. In the next lecture video, I'll continue. Thanks.